Chinese President Hu Jintao leaves Washington for the city of Chicago. Not all smooth sailing. We take a look at recent volatility in Asia's emerging markets. And for the future, China set to strengthen regulation of its rare earth industry. Hello and welcome to this edition of Biz Asia here on CCTV News. I'm Kimberly Harper in Beijing with the latest business and financial news from around the region. Well, after a successful visit to Washington, Chinese President Hu Jintao has continued his state visit in Chicago. He was greeted by Mayor Richard Daley on landing and received a warm welcome from locals.
Chicago put a spectacular welcome for President Hu, a gala dinner with a guest list of 500. During the event, President Hu Jintao expressed his hope for stronger economic cooperation between China and the U.S. He says growth could continue between China and the U.S. with mutual respect, but that the U.S. also should ease trade restrictions on high-tech exports to China.
The restriction on the high-tech product exports to China should be eased as early as possible so that the export of U.S. products to China can be increased. A fair atmosphere should be created for Chinese business investing in the U.S. so that they will have more opportunities to take part in the economic development here.
Chicago is the financial center of the Midwest and also President Barack Obama's hometown. President Hu Jintao will wrap up his 4-day U.S. state visit with stops at a local school and a business expo. Tianxin, CCTV.
Chicago's local economy has suffered since the global financial crisis, so its mayor says the city would appreciate any boost in business activity, especially from China.
For a long time, Chicago represented the U.S. economy, but as manufacturing industry declined in recent years, many cities in the Midwest like Chicago and Detroit lost their glory. By December 2010, Chicago's unemployment rate was as high as 19.4%. While that's much better than that in 2009, Chicago still needs more opportunity. Many locals hope President Hu's visit will help Chinese companies become more familiar with America's third-largest city.
First, I'll be visiting at the state dinner with my wife, Maggie, and we have a special, we're very excited about hosting President Hu's visit to Chicago and surrounding communities and surrounding states and business leaders, and we're very excited and proud to have him here in our city. In the history of Chicago, we're very proud to host the President of China, Hu, here in our great city, and I think people are very proud of that.
The mayor promoted Chicago as a gateway to the U.S. economy, and if Chinese businesses invested there, they would be warmly welcomed. Tianxin, CCTV.
Before boarding for Chicago, President Hu wrapped up the Washington leg of his visit with a call on Congress and business groups. It was in a bid to improve China-US cooperation. Guan Qin reports.
The trip is aimed at enhancing a cooperative and comprehensive relationship between China and the United States. Chinese President Hu Jintao gave a speech at a welcome luncheon hosted by friendly organizations in the U.S. and put forward a 5-point proposal for further development of China-U.S. relations.
In the face of the complex and fluid international situation and various risks and challenges, our countries should step up cooperation and work with people across the world to share opportunities, meet challenges, and build a better future for mankind.
President Hu Jintao also says China would never seek hegemony or pursue an expansionist policy. Earlier, in closed-door meeting on Capitol Hill, the Chinese president met with U.S. lawmakers. He called upon the U.S. Congress to continue helping the two countries to boost relations.
We did have a good meeting with the president of China today. We did discuss our economic relationship. And I would hope that the dialogue on all of these subjects will continue.
On Wednesday, President Hu Jintao held talks with the U.S. President Barack Obama at White House, and they jointly met business leaders from the two countries. The two sides also issued a joint statement agreeing to build a cooperative partnership based on mutual respect and benefit. During the visit, the Obama administration announced business deals with China worth $45 billion, expected to create 235,000 jobs in the U.S. The visit has been praised as successful and of great significance.
It was a very welcome occasion for the United States and, of course, the PRC to get together at the highest level to discuss issues that confront us both, issues that we can solve easily, issues that need long-term negotiations and talks. All in all, it's a very successful visit.
President Hu Jintao said he came for the healthy and stable development of China-US relations. Now I think he has achieved the goal. It sets the tone for the development of the relations in the second decade of the 21st century.
But disputes remain, including issues of human rights, the value of China's currency, and U.S. control on high-tech exports, trade, and investment barriers. President Hu Jintao is visiting the United States at a key time for the economic transformation of China and the U.S., and also for the world economic recovery. The visit is expected to open a new chapter for China-U.S. relations, to jointly promote economic development of the two countries and to realize strong, sustainable, and balanced global growth. Guanxing, CCTV, Beijing.
Well, now let's turn our attention to the equity markets, and Zhang Juanfeng is standing by as usual at the board with all the details. And Juanfeng, property and banking stocks on the move again today on the mainland markets.
Yes, they did, and they moved in the benefit of the overall market. That's why you see an upward land.
Right, fantastic.
Hello, the Chinese mainland markets ended a very volatile week with a decent gain on Friday. Investors looked for bargains among blue chips such as banking and property stocks. At mid-morning, a rally among heavyweight stocks took the Shanghai Composite from flat to a 2.5% gain. The rally was really surprised many investors who were glad to see that, but still skittish after two big market falls this week. So many took the money off the table, but the index still managed to lock in a 1.4% gain. It finished at 2,715, seemingly to have found temporary support at 2,700. And it's saying most investors came back from yesterday's heavy selling and realized they've overdone it. After all, China's robust economic growth and corporate earnings don't warrant the recent market fall. The Shanghai Composite is still down 2.7% and has dropped 3.3% so far this year. It's largely due to speculation of a further monetary tightening, including an imminent rate hike that took out nearly 3% of the market value on Thursday. Now to Hong Kong. Today, the two markets went separate ways. Hong Kong stocks traded briefly in positive territory in mid-morning, but slipped back into the losing area and never looked back. This is because energy shares pulled the market lower. The Hang Seng fell 0.5% to 23,876. Yes, down below the 24,000 line. Also, investors remained cautious before more earnings and corporate and economic data from the U.S. After all, the Hang Seng has already gained over 5% since the beginning of the year, so it's reasonable to have some consolidation before a weekend. Joining us now is David Inglis in Shanghai and Kathy Yang in Hong Kong. Hello there.
Good evening. Happy Friday to you both.
Happy Friday. The mainland markets rebounded convincingly from that miserable session yesterday, while Hong Kong didn't exactly close the week on a high note. So, David, we can never count on mainland investors, can we?
That's right, Junfeng, never count them out. Last night we did talk about how the market was already oversold, and after those massive losses yesterday, mainland investors jumped back in, picking up a lot of these cheap large caps. At one point we were up by as much as 2.5%, as you mentioned, but we did retreat slightly in the afternoon session. But right now we still sit convincingly above that major support level of 2,700. So good day today.
Good day. Kathy, it looks like no matter how well Shanghai did, Hong Kong just looked away.
Oh, yes. Investors here chose to wallow in misery, Junfeng. The tumble in the wider regional market spooked risk takers. Investors here sympathized, if you will, on concerns in the global level that it's not just that the mainland has to step up those tightening measures, but also that emerging nations like India and Indonesia are behind the ball controlling inflation. So apart from stocks, with the exception, of course, of Shanghai, even commodities pulled back because of the same worries that tighter measures will slow global growth. And ironic, isn't it, David, that Shanghai, nearest to ground zero, if you will, to the tightening measures, managed to attract bargain hunters?
Well, Kathy, I guess the Chinese are just good. They know a good bargain when they see one, don't they? But good point you brought up. I wouldn't say today was a case of unbridled optimism. They are. Yeah, I think today was more a case of opportunistic buying, since yesterday's irrational selling did make a lot of these valuations enticingly attractive. Remember, the market did pull back slightly in the afternoon, which still hints a bit of caution going into the weekend. And looking at the swap market, China's one-year interest rate swaps are now at their highest level in 2 years, which essentially means companies are already pricing in a rate increase very soon.
Kathy?
You know, there's a different dynamic going on here because investors in Hong Kong have been less keen about taking a long position in Chinese shares. In fact, some have taken the bearish view. You look at the short interest in the iShares exchange-traded fund, that pretty much tracks the top 50 mainland shares. It rose to over 20% on Thursday. But with some of those bets likely paying off for the ETF down 3.25% in the past 5 days, traders are saying a bout of short covering could lend some support for the 8 shares here in Hong Kong next week. So just watch them bounce back. Junfeng?
Right. Well, let's look at the positive sides. Very strong gains across a lot of sectors today. But David, which ones would you say really drove it forward?
Well, if I was to pick a few, I think these would be property and industrials, especially those railway stocks, which I think apart from yesterday have been riding on very strong momentum this week. The property index gained 3.8% today, with the usual large caps like Gemdale, Poly, and Vanka all pushing up substantially. The sector also benefited from news that top investment bank Goldman Sachs upgraded its sector call to overweight from neutral. Now, moving on to the industrial space, train makers as well as these key suppliers did also put on some decent gains, some even as high as 8%. The sector is still getting a continued boost from the large deals that are falling through in the U.S. as part of President Hu Jintao's trip.
And Kathy, worries over further tightening measures on the mainland are not new. So why did concern about that rear its ugly head again in Hong Kong?
Yeah, you know, Junfeng, the GDP and inflation results that came out this week reminded investors that it's still the same set of problems they're up against in the mainland, that more needs to be done to stamp out inflation. And that most probably includes tightening lending rules. But you know, mainland financial companies aren't sitting it out. They know their margins are going to get squeezed with tighter lending rules, so they're branching out outside the mainland. Take, for instance, CITIC Securities. I spoke with its managing director, Joe Chen, visiting from Beijing. I had a chat with him last night in an awarding ceremony here. He said CITIC is striving for what he calls new profitability points. So they're going to try to go beyond the borders and do business here in Hong Kong, be it in equity, bonds, derivatives, commodities, and currency trading. So in a way, the path for mainland banks is really to use Hong Kong as a staging point to keep growing, while the government there does its job trying to slow the economy to a soft landing. Junfeng?
Okay, thanks very much. That's all the time we have for you guys. We'll see you next week.
See you on Monday.
Thanks. That's David Inglis from Shanghai, Kathy Yan from Hong Kong. Let's move to Tokyo. Shares dropped sharply as rising expectations that China may increase interest rate triggered a broad sell-off. The Nikkei fell 1.6% to 10,274. Remember, yesterday the index already dropped 1.1%. The two-day losing streak easily made this week the worst in 3 months. Commodity prices were lower, following the logic that if China's interest rate is hiked, its economy growth will cool and demand for commodities will drop. Related stocks were broadly lower in Tokyo. Now, for more, we're joined by Toshi Maeda from Tokyo. Good evening, Toshi.
Hi, good evening, Junfeng.
Well, did the effect of China's GDP figures released yesterday continue to linger there today?
That's very true, Junfeng. The concern that Beijing might tighten monetary policy following those strong Chinese GDP data yesterday is still out there, and that concern sent commodity prices down and eventually triggered a commodity sell-off. And some market players apparently used this opportunity as a perfect excuse to pocket profits, as the Tokyo market has been fairly overheated in the past few months. And some analysts say a majority of Tokyo market participants had been waiting for an opportunity like this, actually, to take profits after the recent rally. And the Nikkei ended today down 1.6%, and it was the biggest daily fall in 2 months. As some observers say that the Nikkei may be entering a temporary correction stage. With that said, optimism still pervades, especially in the long term, and many believe that the Japanese index will pick up and rise towards April. Meanwhile, among energy-related shares which had led the Nikkei's recent rally, Japan's biggest trading house, Mitsubishi, fell 4% and 4.5%, and fellow trader Mitsui also shed more than 3%. Jinfan.
Right. Toshi, media reports in Japan suggest Chinese computer maker Lenovo might tie up with Japan's NEC in personal computing. What's the latest on this possible deal?
Well, Junfan, Japan's Nihon Keizai Daily reported this morning that China's Lenovo is in talks to take a majority stake in the PC unit of Japan's NEC, which is the largest PC company in Japan, controlling about 20% of the domestic PC market share. Although neither company has confirmed this report yet, what this possible tie-up means potentially is for Lenovo to join the ranks of the world's top 3 PC manufacturers. Currently, Lenovo ranks 4th in the global PC market, behind Hewlett-Packard, Dell, and Taiwan's Acer. Meanwhile, NEC ranks number 12 globally, but analysts say that through this China-Japan tie-up, Lenovo would be able to expand its share of the Japanese market while also tapping NEC's technology for development. And if this deal does go ahead, it would add to a growing trend of Chinese companies investing in Japanese corporations despite the strong yen. NEC, in turn, would have access to a fast-growing Chinese market while hedging its exposure to a slowing demand for PCs due to the popularity of smartphones and tablet devices. Investors, meanwhile, welcomed the news of a possible tie-up between Lenovo and NEC. Shares of NEC ended the day up 2%, becoming the second biggest gainer among the Nikkei index components today.
Fantastic. Thanks so much. Toshi Maeda from Tokyo. Now let's take a quick look at the closing figures of major index around Asia. That's all I have for today's regional markets. I'm Zheng Junfeng. Well, Kimberly, no matter how fluctuating and volatile the Chinese market has been this week, there's no comparison between it to the Bangladesh stock index.
No, it's been very volatile, to say the least, over the last month.
Right.
Well, Bangladesh's Dhaka Stock Exchange plummeted 8 7/10% yesterday. Its 4th such fall in a month. The benchmark index plunged 600 points in just 6 minutes, and market trading was suspended instantly. Protesters took to the streets once again, fed up with the free fall. Now, keep in mind, this comes just one day after the country's circuit breaker system took effect. Under the new system, trading is halted when the index increases or decreases by 225 points or more. Since early December, the Dhaka has fallen nearly 30%. Well, today finishes off a roller coaster ride of a week for a few other Asian stock exchanges as well. Deirdre Wong-Morris takes a look at recent volatility in Asia's emerging markets that is reminding investors of the risks involved.
2010 was a banner year for emerging markets. India's BSE Sensex up over 17%. Thailand's stock market up 40%, and Indonesia's benchmark index up a whopping 46%. Last year, investors sought fast and high returns in emerging markets, but so far 2011 has been a different story. India has fallen 7% since setting a record high last November. Bangladesh's stock market, which jumped 96% last year, has spiraled in recent weeks, setting off violent riots. And markets in Southeast Asia have fallen as well, though not as sharply.
The recent drop-off of emerging markets is reminding investors of the risk of growth at any cost. And although the Shanghai Composite was one of the worst performing indices of 2010, it has been largely immune to the recent declines. Many analysts are predicting big gains in the year ahead.
Yet while markets can and often do change on a dime, Jing Ulrich, JP Morgan's chairman of equities and commodities, is one industry insider expecting big things in the year to come.
I think this correction in the emerging markets and in Asia in general is actually normal after a very strong year in 2010. The China market, of course, did very differently compared to the Southeast Asian markets in 2010. China underperformed, Southeast Asia outperformed. I think in 2011, we are going to see China attracting more investor dollars. That is because you can see the economic growth being very strong. You're seeing the Chinese government trying to balance the various growth drivers, focusing a lot more on consumption. And in addition, the Chinese market is inexpensive. If you look at Shanghai, you look at Hong Kong, you look at some of the Hong Kong listed China shares, they're trading at around 12 times PE ratio. And that's quite inexpensive relative to their growth prospects.
Already this year, mainland investors have had to deal with their first bit of uncertainty, an unexpected reserve ratio hike that sent the benchmark index tumbling 3% in just one session. But with strong economic growth expected to continue in 2011, many analysts say there's a lot of upside. Deirdre Wong-Morris, CCTV, Beijing.
We debate and discuss to push the envelope. China needs dialogue to facilitate integration. We call for deep, intellectual,
use its yuan,
assertive.
It is the fundamental problem.
Level playing. Observant.
In an age of multilateralism.
Graceful, universal elevation. This is dialogue, where ideas do matter. Asian perspectives and insights. The multiple Asian agendas. Headlining whatever Asia has a stake in. And for a better understanding of the emerging continent, past and present. Asia Today is your trusted link to the continent.
Welcome back. China says it will strengthen regulation of its rare earth industry for the sector's sustainable development. The country says it will manage its rare earth exports based on WTO rules. Liu Ying reports.
The Ministry of Commerce says China exported 35,000 tons of rare earths in the first 11 months of 2010. That's a volume increase of 14% compared with 2009. China earlier released its first round of rare earth export quotas for 2011, which saw a cut of 11% from last year. The ministry says the quota for the whole of 2011 is still under consultation, but it stressed the country will manage its export quota in line with WTO rules.
We will study our export policies in conjunction with policies on exploitation and refining. China will continue to supply rare earth materials to the international market and will manage our export quota based on WTO rules.
Industry insiders say China's rare earth reserves have been dwindling, and its exports have been disproportionate to its reserve.
As at the end of 2009, China's reserve dropped to 36 million tons, accounting for 36% of the world's total. Yet China's exports take up more than 90% of global supply. In contrast, the US and Russia have considerable proportions, but their production is still zero.
China has taken a combination of measures to strengthen the management of exploitation and export of rare earth. The country on Wednesday released a list of 11 state-designated areas for rare earth mining. Under the new policy, only companies authorized by the central government can conduct surveying and exploitation in those areas. Industry insiders say the new policy will help prevent overexploitation of the strategic resource and ensure steady and long-term supply. China's rare earth reserves have fallen by nearly a half during the past 5 years due to ever-growing exports. The country believes strengthening export and exploitation management is important for the sector's sustainable development. In the meantime, China also hopes to cooperate with other countries to jointly meet the global demand. Liu Ying, CCTV, Beijing.
An official with China's top economic planner says the country is still facing heavy inflationary pressures. But he adds that the government is considering fresh measures to address the issue.
Zhou Wangjun, an official with NDRC's price department, made remarks after the Statistics Authority released China's economic figures on Thursday. The data shows fresh vegetable prices went down by 9.4% month-on-month in December. Zhou says the decline in that area is partially due to the government's efforts to curb commodity prices. But Zhou admits inflationary pressures are prevalent this quarter and consumer prices are expected to remain high. The official says the NDRC is fully prepared to stabilize consumer prices and is set to roll out a series of curbing measures.
We will take long-term measures and adjust residents' salaries and poverty claims according to consumer prices. We will continue to use vegetable prices as a major gauge for appraising the performance of local chief officials. We will also encourage farm production to boost market supply and therefore stabilize prices.
Zhou added that the government is considering plans to boost commodity reserves to prevent price fluctuations. Zhou says these policies will play a fundamental role in stabilizing prices. So Yun, CCTV.
That's all we have time for here on Biz Asia on CCTV News. I'm Kimberly Harper in Beijing and I'll be back at 9 p.m. local time. I hope to see you then. Thanks for your company.